Welcome. You've joined us for another deep dive.
Great to be diving in.
Today, we're cutting straight to the heart of things. What's really going on with the economy? And are we looking at a sustained period of higher prices?
That's the big question, isn't it?
Exactly. Our guide for this is the latest Gloom, Boom, and Doom report. It's quite a mixed market data history, some, well, pretty sharp observations.
It pulls together a lot of threads.
So the core question we're really tackling for you today is, are we moving into a significant inflationary upcycle? And what could that actually mean for the economy and maybe more importantly for your investments?
That's exactly what we want to unpack. This report, it lays out a kind of web of interconnected ideas. And maybe a good place to start. A key thread is China.
China's reopening.
Yes, China's economic reopening and what that might mean for global demand.
Okay, let's get right into that. Interestingly, the author starts off with a quick note, sort of an apology, about a previous attribution error. Mentions Alpine Macro, Tony Boak.
The bank credit analyst, too.
Right. It just kind of sets the stage, shows the author's been in this game a long time. But yeah, the immediate focus is China getting back to business.
And what's really worth considering here is the potential surge in demand for, well, raw materials, commodities, that China's reopening might trigger.
Right.
The report points to some analysis from Yan Wang and David Abramson over at Alpine Macro. They're suggesting, real potential for gains in Chinese stocks, emerging markets, too, as China kind of shifts gears towards growth.
And it's not just China, is it? The author then widens the lens, looks at India, Pakistan, Bangladesh, Indonesia.
Suggesting a similar demand surge there.
Potentially, yeah. And to give you a sense of the scale, think about this. India's oil use per person right now, about 51 gallons a year.
Okay.
But the report suggests it could, well, more than double, jump over 100 gallons. Imagine the sheer volume if that actually happens across India and its neighbors.
Wow. Yeah, if you connect that to the bigger picture, I mean, a simultaneous demand jump from these huge populations, that's got to put upward pressure on commodity prices, especially oil.
Definitely. The report notes the recent dip in oil prices, sure, but it also reminds us about the longer trend.
Which has been generally upward since the Fed was founded, right?
Yeah.
Linking it to money supply.
Exactly. Linked to the sort of constant increase in money circulating.
Now, here's where it gets kind of counterintuitive, maybe.
Yeah.
While oil prices in dollars have climbed long term,
Yeah.
the real price, adjusted for inflation, surprisingly stable, according to the report.
Stable in real terms. That's interesting.
And then there's this historical oddity. During World War II, oil prices didn't actually go up in dollar terms.
They didn't.
No, and they actually fell in real inflation-adjusted terms, which is, pretty different from what happened in most other big wars.
Huh. So what's the takeaway there?
Well, it raises this really important point about how, global events and commodity prices connect, or sometimes don't connect in the way you'd expect. The author uses it to underline a key idea
Yeah.
during periods of, let's call it, monetary inflation.
When there's just a lot more money sloshing around.
Exactly. Price movements can seem random. They might not make immediate sense. So for you as an investor, it means, well, you need to be ready for surprises in the data, unexpected market moves.
Absolutely. And speaking of unexpected data or maybe conflicting data, the report digs into some worrying signs in the U.S. economy right now, things that affect you directly.
Like that Fed chart.
Yeah. The Federal Reserve chart showing a big drop, the biggest since the Great Depression, actually, minus 6.35% in U.S. real disposable personal income in 2022.
So that's your spending money after taxes and after you account for inflation. A drop that big is concerning. It really speaks to the average person's purchasing power getting squeezed.
It does. But then here's the contrast. You look at retail sales data. Bloomberg's numbers for January showed a 3% increase.
An increase. How does that square?
Well, all 13 categories were up. Car dealers, furniture stores, restaurants. Sales numbers looked, on the surface, pretty good.
But the catch is?
The catch is those numbers aren't adjusted for inflation. That's the key thing for you to grasp. When you think about, say, Valentine's Day gifts costing 6.4% more.
Or eating out being over 8% pricier year on year.
Right. Suddenly that 3% nominal increase in sales, it probably means people are actually buying less stuff, just paying more for it.
So inflation is masking a potential underlying weakness. People are spending more just to stand still, basically?
Exactly. It really hits home. And the report mentions that CNBC stat 64% of Americans living paycheck to paycheck.
And even people earning six figures feeling stretched.
Yeah, a growing number. Which I think leads us nicely into this idea of the cost of thriving index.
Ah, yes, Oren Cass's-Cody from the FT.
Tell us about that. It sounds like a really powerful concept for understanding this pressure.
It really is. What's fascinating, I think, is how Cody tries to quantify this increasing difficulty for, like, a typical family to achieve a middle-class life.
Puts a number on it.
Exactly. And the comparison between 1985 and 2022 is, well, it's stark. Back in '85, it took about 40 weeks of the median full-time male income to afford a specific basket of middle-class essentials.
40 weeks. Okay, most of the year.
Right. But by 2022, that jumped to 62 weeks.
62.
Yeah?
That's more than a year's income.
It is. Think about that. What used to take about 10 months of income now takes nearly a year and a half.
Yeah.
It just dramatically shows that erosion of purchasing power the report keeps highlighting.
And we're not talking luxuries here, are we? This is like nutritious food, rent, health insurance, a car, saving for college.
The basics for a middle-class life. For a family with 2 kids, yes. The fact that it takes so much longer now just underscores the pressure many people, maybe you listening, are feeling.
And it's not the same everywhere, is it? The report mentions variations.
That's right, and that's relevant to your own situation. Cody is highest in West Virginia, 79 weeks. California's high too, 73 weeks.
And it hits younger people harder.
It seems so. Younger men, specifically mentioned with a Cody of 73, and potentially higher for women because, well, median wages tend to be lower.
And this connects to things like needing 2 parents working full time.
Definitely. And the difficulty of, moving to opportunity if the cost of living in those opportunity areas is just too high.
It's a really clear picture of how the standard inflation numbers, like the CPI, might not tell the whole story about the financial reality people are facing.
No, they don't capture this lived experience fully. The author even mentions giving speeches back in 2014 using data from Larry Lindsay and Cynthia Research.
Highlighting uneven recovery in wealth and income way back then.
Yeah, using Fed data, actually. But interestingly, it didn't get much traction at the time.
Hmm. So, okay, let's look closer at what is driving the inflation we are seeing reported. The report talks about the sticky parts of the CPI.
Right, the services component.
Yeah.
Things like housing, healthcare, insurance premiums, stuff like that. It's rising at over 7% per year.
And unlike, say, gasoline prices, these service costs tend to stay high or keep rising.
Generally, yes. They're less volatile, more persistent, they tend to stick around.
Okay, so service inflation is high and sticky. But then the report points out something really odd.
Which is?
People's expectations about future inflation have actually collapsed, fallen quite sharply.
That is counterintuitive, isn't it? You'd think with high sticky inflation, people would expect it to continue.
You would. So how do we make sense of that? The report brings in John Greenwood and Steve Hank.
Ah, yes, they're Wall Street Journal pieces. They initially predicted persistent inflation, didn't they? Based on the quantity theory of money.
They did, basically arguing that the huge increase in the money supply would inevitably lead to higher prices, and, well, they were pretty much right about that initial surge.
But now their view has shifted.
Yeah.
Quite dramatically.
Which is important for you listening to know. What are they saying now?
Well, now they argue inflation is actually likely to fall, potentially quite sharply.
Why the change?
Because of the money supply again, but in reverse. They point to the dramatic contraction in M2, that broad measure of money. It's shrinking at, get this, the steepest rate in post-war U.S. history.
Wow. Steepest ever.
In the post-war era, yes.
Yeah.
Based on recent annualized rates. So they've lowered their forecast for year-end 2023 inflation down to somewhere between 2% and 5%.
So for you listening, that shrinking money supply could mean some relief from rising prices down the line.
It suggests some of that upward pressure might be easing, yes. But there's always a but.
Always. What's the concern?
They worry about a recession. They think the Fed is maybe looking at the wrong thing, focusing too much on the Phillips curve, that inflation-employment trade-off.
And might keep tightening policy, raising rates, even as the money supply is already shrinking rapidly.
Exactly. And the report's author seems to lean towards agreeing with Greenwood and Hank here, especially looking at the collapse in the real U.S. monetary base.
Okay, so that's one view. Money supply shrinking, inflation should fall, but recession risk is rising because the Fed might overdo it.
But it's not the only view presented. The report brings in counter-arguments. Larry Lindsay, for instance.
What's his take?
He suggests that maybe Fed policy isn't really that tight yet, because interest rates are still below the actual rate of inflation.
So in real terms, rates are still negative.
Effectively, yes. And then there's a tweet mentioned from Gordon Johnson using the Taylor rule.
Which is like a formula for where rates should be based on inflation and the economy.
Kind of, yeah, a guideline. And according to that rule, Johnson calculated the Fed funds rate should be way higher, like 9%.
9% compared to where it is now. That's a huge gap. So that argues policy is still way too loose.
It's certainly an argument that it might be, yes. And maybe we see signs of that looseness elsewhere.
Like where?
Well, the report mentions the recent bounce in more speculative stuff, certain stocks, crypto, that could suggest financial conditions aren't that tight.
And Peter Berezin from Bank Credit Analyst points to lots of excess savings still floating around the economy.
Right. Which then leads to looking at broader measures, like Ned Davis Research's Index.
The Real Monetary, Fiscal, and Exchange Rate Policy Index. Bit of a mouthful.
Yeah. But it tries to combine everything monetary, government spending, exchange rates. And that index suggests policy has actually been kind of easing since early 2022, in a zone usually considered bullish for markets.
But is easing always good when inflation's the main worry? The author questions that.
That's a fair question. The author seems to prefer simpler liquidity indicators,
Right.
like the spread between riskier corporate bonds, BBB-rated ones, and safe treasury bills.
And what's that showing?
It hasn't really widened dramatically, which kind of suggests, again, maybe policy isn't biting as hard as some think.
Okay, so lots of conflicting signals within the U.S., but there's a global dimension too, right? Central banks elsewhere.
Absolutely crucial. That Gordon Johnson tweet again, he highlighted that the world's top 10 central banks, collectively, actually injected liquidity recently. Over $650 billion in just 2 months.
Whoa, where did that come from mainly?
A lot of it from the People's Bank of China. So you have this global liquidity potentially working against what the Fed is trying to do in the U.S.
Which might explain something else mentioned, why real yields on U.S. T-bills are still negative, even with the Fed hikes.
It could definitely be a contributing factor. It's a real puzzle, isn't it? Where can your money actually earn a positive return after inflation?
Which leads right into Aaron Brown's Bloomberg piece. He asks why T-bills paying 5% are seen as, like, hardly a bargain.
Yeah, his argument is interesting. He says, look, given inflation and where the effective Fed rate is, Treasuries seem priced for perfection, like only the best-case scenario.
Meaning they have more room to fall in price than to rise.
That's his point. More downside than upside. He contrasts that with stocks, volatile, sure, but maybe offering more potential in both directions. Two-sided potential.
So how does the report try to square all this? Greenwood and Hank saying inflation falls, Brown saying treasuries are risky.
The author suggests, well, maybe they can both be right, just at different times.
How so?
Maybe we get declining inflation first, like Greenwood and Hank expect, possibly due to demand slowing down.
A recession, maybe.
Or just significant slowing. But then maybe inflation comes back later. Perhaps in a recovery, or if central banks fire up the money printers again, more QE.
So a potential dip, then another rise.
That's one possible scenario floated. You might even see a bond rally in the short term if 10-year yields drop further.
Yeah.
But the author's overall sense seems to be, well, policy isn't tight enough to kill inflation for good.
Okay.
But maybe tight enough to stop asset prices from just going straight up forever, suggesting a longer-term upward wave in both inflation and interest rates.
Right. So given all that complexity and uncertainty, what does this mean for investments? What should you, the listener, be thinking about?
Well, the report gets quite practical here. With modest return expectations overall, those one-year Treasury bills paying nearly 5% start to look pretty alluring.
Yeah.
Relatively safe yield.
Makes sense in this environment. And the Alpine macro team's view backs that caution, right? Expecting inflation to fall significantly, plus that Cody index showing demand destruction.
Exactly. It reinforces a more defensive stance, perhaps. The report also reminds us, the bear market that started back in late 2021, it might not be over yet.
Still could be further to fall, especially for some of those glamour stocks.
Potentially. There's a chart comparing them to the dot-com era. And history shows real equity drawdowns adjusted for inflation can last a very long time, over 10 years sometimes.
Oof, 10 years. That's sobering.
It is. But on the flip side, the author points out that some markets, some individual stocks, they've been in bear markets for years already. Maybe they've already bought them.
Like where? Any examples?
China Mobile is mentioned, with a pretty chunky dividend yield, around 9%. The author discloses holding Hong Kong China stocks and new positions in cement companies.
Interesting. In China and elsewhere.
Anhui Conch in China, but also Thai and European cement stocks. It signals a shift, perhaps.
Or shift towards.
Towards Specific sectors, specific companies, maybe away from just buying the whole index. Stock picking might be coming back into vogue.
Okay. What else looked interesting?
Other telecoms globally, like Orange, showing strength. And Vietnam is highlighted as potentially interesting again after being stagnant for a while.
Vietnam. Lower valuations there, maybe.
Seems to be the idea. Thomas Hugger's view on lower PE ratios is mentioned, along with a specific investment fund. The key takeaway seems to be it's becoming a market of stocks, not just the market. Individual selection matters more.
Which leads us to Sean and Mike O'Higgins and their strategy. They have a pretty strong view on where things are headed, don't they?
Oh, definitely. They argue forcefully that the whole era of low rates, low inflation, growth stock dominance, that's over. Done.
So what do they recommend instead?
They advocate replacing bonds, to a large extent, with precious metals, and they particularly favor platinum right now.
Platinum over gold.
In their current view, yes. And their historical analysis is interesting for you to consider. It shows value stocks have actually beaten growth stocks by a wide margin over the very long term, despite growth's recent run.
Value's time to shine again, perhaps. What's their specific approach?
Well, during inflationary periods, they suggest something called MOAR plus, 50% in large cap stocks, 50% in gold. But right now, they're leaning towards platinum and what they call dogs of the world.
Dogs of the world. Catchy name.
Yeah. Basically, stocks in certain countries, Brazil, China, Italy, Korea, Spain, that they see as trading at a big discount, like 60% below fair value.
Okay, so platinum and undervalued international stocks. But you mentioned platinum. The report then raises some serious flags about it, doesn't it?
It does. Through an analysis by Ryan Blanchett, focusing specifically on South Africa. It's a critical piece of the puzzle if you're considering platinum.
Why South Africa specifically?
Because that's where almost all of it comes from. Around 85% of all platinum ever mined originates there. This huge concentration geographically in one complex, nationally in one country, creates massive risks.
Risks to supply.
Exactly. Risks to supply, risks to price stability. Blanchett calls them squeeze factors. The natural concentration, the national concentration, plus the fact that platinum is just inherently rare. And the trading market for it isn't huge either.
And is supply already an issue?
Yes. South Africa's annual production has been declining. Lower ore grades, the easiest stuff is gone. You know the story.
Standard mining challenges.
True. But then add the man-made problems. South Africa's energy crisis, the blackouts, load shedding, it's crippling the mining industry. Production was way down last year, expected to fall further. It's a direct hit to supply.
Wow. Energy crisis impacting platinum supply. What else?
Social and political instability. High crime, unrest like the riots in 2021. It makes investment risky, hurts the country's reputation. International rankings show that.
Okay, so geological concentration, energy crisis, social instability, anything else?
ESG. Environmental, social, governance policies. The growing focus on these could make mining even harder, more expensive, which might paradoxically increase the value of platinum that's already been mined. A self-imposed conundrum, as the report calls it.
Interesting. And geopolitics.
Big time. South Africa's ties with Russia and China through BRICS. Talk of de-dollarization, potential minerals war. It raises questions about Western access to South African platinum down the road.
Especially with China and Russia increasing their influence across Africa.
Precisely. Africa is becoming a key battleground for these critical resources. The West is trying to re-engage, but it's a complex picture.
Has concern about South African supply moved prices before?
Yes. Historically, worries about disruptions there have definitely pushed platinum prices higher, and looking ahead, if the hydrogen economy takes off.
Which uses platinum in fuel cells.
Right. Demand could surge. But those very supply risks might also push users to find alternatives long-term. It's a double-edged sword.
So wrapping this all up, after diving into the Gloom, Boom, and Doom report, it's definitely clear that the economic forces we're seeing are, well, incredibly complex, tangled up together.
Very much so. We've looked at these conflicting signals on inflation, the debate about whether policy is actually tight or not.
That rising cost of living, the Cody index showing the squeeze.
And then these very specific concentrated risks around a key commodity like platinum, tied to everything from energy crises to geopolitics.
It really forces you, the listener, to weigh these different viewpoints, doesn't it? Like Greenwood and Hank versus Aaron Brown on bonds, or the case for value stocks versus the risks in specific commodities.
Absolutely. There are no easy answers here. It highlights the need for really careful consideration of how these trends might play out and what they mean for your own decisions.
Which brings us to maybe a final thought. The report mentions a quote from Victor Teicher about appreciating our current circumstances amid all the global uncertainty and potential escalations.
A reminder to maybe take stock.
Yeah, perhaps. In a world that feels like it's constantly shifting, maybe taking a moment to really process the kind of information we've discussed today, thinking about its relevance. Maybe that's the most valuable thing you can do.
A thoughtful way to end it.
Thank you for taking this deep dive with us.